that long. I know some of you may have plans for Valentine's Day. I can't think of anything better than getting your money right before you go out and spend it on expensive dinners and chocolates. And with that, Cynthia, take it away, please. And welcome back. We're super excited to have you.
Thank you, Don, for that warm welcome. And it's so relevant. I love it. We're talking about investing, but I love it. Y'all are investing in yourselves today by learning how to be super effective with your money. So yeah, I'm really excited. Let me go ahead and do a screen share so I can share my screen and then we can get going. So, welcome everyone. My name is Cynthia Diaz. I'm, the founder and CEO of my company, Financial Space. Those of you that were here the last session, welcome back. And those of you that haven't attended one of my workshops before, super welcome. It's nice to have you here. And so just a little bit about me. I've labeled myself a first gen wealth builder. I'm first in my family to go off to college, first in my family on track to hit that $1 million, portfolio, first in my family to start a business. There's a lot of firsts there. And so I love working with other first gen folks. So if there's any other first gen folks that are here, let me know, put an emoji. I would love to know that you're here. So I started my company to help, people of color, just wanting to teach them how to build wealth, because a lot of this information, as you know, isn't taught in the school system, traditionally isn't taught. I went through college, went through my master's degree, never knowing how to invest money. I was taught to save, but wasn't taught to invest. And that I think is a really huge component to creating generational wealth. So I'm really passionate about that. I am a certified financial education instructor. And so, I'm really excited to be here. So with that, let's dive in. So I just want to preface that for today, the presentation is just for educational purposes only. I'm definitely not giving you financial advice or just investment advice in general. We are just here to learn, and hopefully you'll get some ideas so that you can start your wealth building journey. And I definitely try to make these presentations whenever I'm doing a webinar as engaging as I possibly can. And so it would be amazing if y'all on your phone, or if you open up a separate tab on a new browser, if you can go to menti.com and you just enter the code. And the more you engage with the questions, one, it gives us a sense of who's in the room, but two, it allows you to reflect on where you're at. And then three, it allows you to enter questions anonymously. So I know a lot of the times when we're talking about money, it can be very emotional, right? Money is psychological. And so I know we may not always feel comfortable asking questions about money. I know that I, for a very long time, felt like I was behind on my financial journey, on my investing journey, like, oh my goodness, I'm so late to this. And so I definitely don't want anyone feeling like this today. We're going to leave the shame, the judgment, all of this at the door. We're going to come super pumped, ready to learn how to start building that wealth. So thanks y'all for hopping in here. I see a few of you hopped in here already. And so feel free, as we're going through the presentation, you can either enter your questions in the chat, or if you want to do them anonymously through Menti, that also works. Cool. So just to get us started, when you think about investing, what thoughts or feelings come up? So again, you can enter them in the chat or even here on Menti, but investing can be a very heavy, loaded word. But when you think of investing, what are some words? Stocks. I love it, right? We usually think stocks. What other words or even feelings can come up? Wealth. Yes. Risk. Yes. Fear. These are really great words. I can relate to all of these so far. Long term. Yes, absolutely. I'm so glad that I'm seeing long term here, because as investors, we're definitely thinking long term. A lot of the times when people tell me, oh, well, when you're investing, it's like gambling. It is like gambling if you don't know what you're doing and you're thinking that of investing as like a get rich quick type of thing, which it isn't. Investors have a long-term mindset. So I love to see that word on here. Real estate, yes, the future. We're seeing some anxiety here, right? Especially with this year. We've been in a what we call a bear market, and I'll be talking about what that means. And so that can definitely bring up some anxiety when you're seeing the market, right? Your investments not in a high place, uncertainty, potential. Yes, I love that. Diversification, growth, legacy. Yes, these are all really great words that, convey all of this. So I love to see all of this because as we can see, there's some similarities here with some of the words. There's also a lot of diversity here as well in terms of how we each view investing and what thoughts or feelings may come up. So keep them coming. I love it. Thanks y'all for participating. And, the second question, why do you want to learn how to build wealth? And I think this is a really important question to ask yourself. Again, because when we're thinking about investments, we have to have that long-term mindset. We're in it for the long haul, right? Regardless of what happens in the market, whether it's the stock market or even when we're thinking about real estate investing, we're in it for the long haul. So what's the end goal here? And I want you to also start thinking about what the end goal is, because as we're talking about different investment accounts, which I will be breaking down the different types, a regular IRA, a Roth IRA, a taxable brokerage, what are all of these accounts, right? It's important that we go into each of these accounts having a goal in mind. When do I want to touch this money? Because some of these accounts, your money's locked in. Some are more fluid. So we want to know, what is the purpose of that money? Awesome, Arthur, retire early. Yes, that's actually my goal. I actually don't use the word retire. I like the word work optional, right? I think Serena Williams had a great quote about, she wasn't retiring. She was evolving into a new phase of her life. And I really love that because I don't think retirement is what it was in the past. I think now most folks want options. And that's the beauty of saving and investing for the future, right? So I love it to pass it to my children, to be happier, to have more time to focus on my passion. Yes, financial freedom. These are all really great reasons why you would want to build wealth. And, just a little background, growing up, were you taught to save, invest, or both? Now I'll share that for me, I was just taught to save. I definitely did not come from a family that said, hey, we need to, once you go to college and you get a great job, you need to become an investor and put your money to work. And granted, my family didn't know better. So they just said, go to college, save, and then buy a house. And that's it. And so the wealth building portion for me definitely was left out. And so awesome. So we're seeing that the majority here was taught to save, and then a good handful of you were also taught both, which is great. Those of you that were taught both, amazing. And do you think it's possible for you to retire a millionaire? What do you think? All right, I love it. We're seeing some optimism here. Yes. And we have a person that's got to think about it. That's fair. That's fair, right? You may want to think about the calculations, but I love that we're seeing the majority of folks that are saying, yes, it is possible for me to get there. Awesome. And are you contributing to your employer-sponsored retirement account? So if you're working part-time, not all employers will offer this benefit to you. Even full-timers, actually, it just depends on the company. But if you are offered this, even as a part-time student, are you contributing? And if you're not, that's okay. I know that's a lot of the times, that's not the priority. But hopefully after today, if you are offered an employer-sponsored retirement account, maybe you'll be motivated to contribute, even if it's just a little bit. I always share with clients, a lot of the times when we think about investing, we have in our heads that it has to be a lot of money. And the reality is that it doesn't. We could literally start with like $20. If that's what you have for the month, start there. What's important is to build that habit of putting a little bit into your account versus not doing anything at all. A little bit is better than nothing. Awesome. And Elsie says, I have an IRA. Yes. Awesome. An IRA is great. Now, if you are contributing to your employer-sponsored retirement account, do you know what type of account it is? Or is it one of those things where I know I contribute money into my employer takes money, but I have no idea what happens? And maybe you don't know. That's okay. We're going to talk about that today. And maybe you just haven't gotten to a place that you're contributing. And if you're not contributing again, hopefully today you're going to learn all the tools so that when you are ready, you're going to go in there prepared. You're going to know how to look at those accounts, and you're going to feel good about how to sign up, what to purchase, and how to do that. So awesome. And the last question. Do you have investment accounts outside of work? Does anyone in here have an investment account that they've opened up outside of work? Maybe a Roth IRA, maybe a taxable brokerage account. Maybe you don't, and that's okay. We're here to learn. So this is going to be a great place to learn today about investment accounts outside of work. So awesome. So we do have, looks like we have a couple of folks in the room that do have a Roth IRA and a taxable brokerage. Okay. Very cool. Looks like that's even. Awesome. Okay. So let's dive in, right? Thanks to y'all for participating. And anyone that didn't get a chance to join the poll, you can always hop in at our next one. So these are some common investing myths that I want to talk about. That you need to have a lot of money. That's the first one that I was alluding to earlier. There's this idea that we have to have hundreds, thousands of dollars or else we can't. That is no longer the case. A lot of brokerages allow you to start investing with $1, $5. I mean, very little. But the idea really when I work with clients is let's look at your budget and let's see if there's a little room. Even if we can carve out $20 a month, let's start funneling that, right? Let's start there with what we can afford. The next myth, you're going to lose all of your money. A lot of the times, I don't know if any of y'all, I used to hear, well, you're gambling your money, anything can happen. And yes, absolutely. Last year when we had that whole thing with like the Dogecoin and all these meme coins and meme stocks, yes, that way you will potentially be losing all your money. There's a lot of risk in day trading. Day trading, buying and selling, all of that is very risky. And so what we're going to talk about here is we're not day traders. We want to go into this with the mindset of an investor that's long-term, 10 years and out. That is when we will start to see the gains in our portfolio. Historically, that's how long it takes. The longer your money is invested in the market, the bigger the gains will be. And the last one, that you need to know how to pick individual stocks. This is a huge misconception in the investing world that you need to go in there and you need to know how to pick individual ones. That's actually not the case. And I'm going to be talking about how with funds, which are like baskets of stocks, you could essentially buy a couple funds or even one that has the entire stock market, which means then you don't have to worry about picking individual ones. You can if you like, that's always up to your discretion, but you don't have to. You don't have to make it complicated or more complicated than what it seems. So let's talk a little bit about saving versus investing, because I think this is really important. So saving is designed for preservation, right? We are trying to, when we have savings goals, unfortunately, all of the money that is in our savings accounts is depreciating in value over the long term. Why? Because of a little thing called inflation that comes in and eats at the value of our dollars, which is why if you are going to have money in a savings account, hopefully a high yield, a high interest savings account, we don't want to have savings in a regular savings account because those banks don't really pay you anything. We definitely want to look at a savings account for short-term goals, maybe your emergency fund, Anything outside of that, we want to invest it. Why? Because investing is designed for growth. This is where we hedge inflation, right? We take a little risk, but the payout over the long term is going to be greater than if we just leave it in a savings account. So I definitely want us to understand the two, because again, as we're looking at our money and we're thinking, well, where should I put this? Really, we come back to this. Well, what's the end goal? Is this a short-term goal? Let's put it in a savings account. Are we thinking now long-term? Let's invest it. So let's take a look at what your money makes, saving versus investing. So you have Mary, who's 30 years old. She's saving $300 every month in a high yield savings account. And this is a little old, 3%. Most high yield banks right now are paying you about a 3.4, 3.5% APY, which is pretty good for the time being. Now, she just continues. Let's say Mary doesn't invest at all. She just continues putting $300 for the rest of her life until 65. She's going to have about $221,000 saved, which isn't bad, right? Lily, on the other hand, is 30 years old. Now, she's investing that money instead in the stock market, and we're seeing an average of a 10% return. Now, at 65, Lily's going to have about $1 million. Now, where does that 10% come from? Well, 10% on average is historically what the stock market has averaged in terms of returns, right? However, this might be a little less than $1 million, because if we want to be more on the conservative side, we may want to take off about 2% to account for inflation. But for the most part, Lily's going to be she's going to be right around there to that $1 million mark at 65 if she chooses to invest versus save. This is a huge difference in terms of where both gals will be at 65. And I see a question in the chat, which is a great question. How long is considered long-term? Anything that I would say you're going to need within the next 5 years, we want to have that readily accessible. We want it fluid. And the reason we don't invest that money is because the stock market is very volatile. The stock market is going to go up and down, and you definitely don't want to invest money that you may need within the next 5 years. So hopefully that helps answer the question a little bit. So let's take a look at someone here. Of course, this person is now in their career. They're making enough money where, they feel I have $500, to invest, right? So this is, for those of y'all, when you get into your careers and you're making, decent money and you feel like, okay, I got this. So let's say you start off, you have $500. And let's say you're just contributing $100 every month into this account. Well, the nice thing is that in 10 years, this account with an 8% return, you're going to have close to, about $19,404 in this account, which is not too bad, right? Considering you started with $500 and each month you're just adding $100. But one thing that I want you to pay attention to here, which is really nice to see, is that your total contributions in those 10 years, you're going to have contributed about $12,000. But look at the interest or the return on your investment, about $6,900, which isn't bad, right? Now, let's say we give this account 20 years to grow, right? Doing the same thing. You open an investment account, start off with $500, and each month you're adding $100 in, and we're using the conservative 8% rate of return. Guess what? In 20 years, this account, it'll be at about $61,000. And look at what's happening down here. Your total contributions, you'll have contributed out of the 61, only about 24K, but look at the interest earned. Your return on this investment, because of the growth of the stock market, is going to be close to $37,000, which means the interest earned is actually going to exceed your contributions. And this is when when people say, oh, put your money to work, make sure your money is working for you. This is what they're talking about. Now, let's say hypothetically, we're going to go longer, 30 years. Same example. You start off with $500 and each month you're just putting $100 in, same rate of return. Well, in 30 years, this account will be at about 154K. And look at this. I mean, sorry about that. Total contributions over the 30 years, your contributions about 36K. And the rate of return, I mean, the interest earned about 118K. And so what I wanted to demonstrate here is really when it comes to investing, time really is your best friend. I mean, it's really about the time in the market, because even with $100 that you're contributing every month, I mean, the younger that you can start, the growth really is exponential. And so this is why I typically recommend to folks, you know, even if you just have a little bit, with whatever little bit that you can afford to send off into that 401k, Roth IRA, taxable, whatever account that it is that you're using, start with that little bit. Now, let's look a little bit at the history of the stock market, because I think a lot of the times, a lot of the fear that comes up when we're thinking about investing is not really even understanding the history and how it functions really. But the stock market has been around for a really long time. And so, you know, the volatility, the up and down that we see, super normal. It's been a part of history. I mean, when we look back, look at all of the different crashes that we've had. I mean, we've had the 1929 one, but then guess what? You know, it did take some time, but the market overall rebounded. And then, you know, we had other crises happen, but of course we've been rebounding. And guess what? 2020, 2019, COVID hit. That was another huge crash. Huge. I mean, my portfolio was just not in a great place. But what do you do during these times? As long-term investors, we hold on, because we know if we're looking at this chart, history tells us historically what we've seen from the data, the market is forward-looking. That graph is going up no matter what. And so this is kind of what we base it off of when we're thinking about, oh my goodness, we've hit a crash. We're currently in not such a good place. Well, historically, we've had crashes and the market has found a way to rebound back. So hopefully this little graph will just kind of put into context that what's happening now has happened before at other junctures in time, in history. Now, again, I just wanted to reiterate, the stock market is cyclical. It's going to do that. We're going to hit a peak, which is a bull market, right? When the market is rising and everybody is excited and people are just, you know, you hear of all these people making money and, you know, there's a lot of hype, right? Everyone's just excited when it's up. And then, of course, we start to see the dips, right? And then we enter these times when it's a bear market. And typically, bear market, you know, I believe the market is down about 20%. And so we've been in a bear market. Recently, the stock market has been doing its thing where we've seen it go up a little bit. We don't know if it'll stay there. Who knows? We can't predict that. That's another thing. You can't predict what the market does. You just kind of roll with it. It's really like a roller coaster ride. We just kind of ride it out. But essentially, you know, in showing this, it's pretty normal. This is what happens. So again, as a long-term investor, we need to understand that volatility is the price that we're paying to see those returns. So the last thing that we want to do when the market is down and we're seeing our portfolios in a place that just doesn't look very great is sell. Because what's happening there, we're selling based off of emotion. We're most likely going to be selling at a loss, and we don't want to do that. And this is why when you're investing, you definitely don't want to invest money that you're going to need within the next 5 years, because guess what? Let's say you start investing up here and you invest money that you're going to need within the next 5 years. Anything can happen within the next 5 years. Let's say we end up here within that time span. You definitely don't at that point want to sell your assets because you would be at a loss. So super key to understand that the market is cyclical and it will have its ups and downs. So I'll pause there. Any questions just about that before I move on? Anything at the moment? Okay. Well, if any other questions come up, you know, feel free to type them out. So now that we have a little bit of understanding of just, the markets, volatility, and that's pretty normal, what are the different assets that you could purchase, right, in this, to begin investing? Well, we have three different types of securities. We have stocks, we have bonds, and then we have these things called funds, which we'll dive deep into right now. So stocks really are, you become part owner in this company. I apologize for the typo there. So essentially, a company decides, you know what, I want to go public, and I'm going to allow other people to buy a little piece of my company, and they can become part owner. That's essentially what you're doing when you decide, I want to buy, a share of stock. I want to become a part owner in that company. Bonds are a little differently. Bonds, you're loaning money, right? So bonds allow the public to loan corporations and municipalities money. So that's how you can think about it. Stocks, part owner; bonds, you're loaning money. Now, ETFs are, these are the baskets of stocks that I was talking about, right? They're groups. So when I said earlier, you don't have to buy individual stocks if you don't want to. You can just buy a grouping. This is what we mean. These funds may have hundreds or even thousands of stocks in one, which is giving you the ultimate diversification, which means you don't have to handpick anything. It's all there for you. So I want to preface that with stocks that you can purchase in the stock market, they can be domestic, American stocks, or they can be international. Now, when you look at how our retirement portfolios are composed, most employers, let's say you decide, you check off, right, with your employer, yep, I want to contribute to my retirement account. Most employers will take that money. They're going to ask you some questions about when you want to retire, and they're going to create what's called a target date fund for you. And that fund is going to have in there domestic stocks and also international stocks. So it's important that you know that too, that in our retirement portfolios, when we're investing with our employer, our money is actually invested all over the place. And so here's the thing with individual stocks, right? They're higher risk, but the potential for higher reward. So when folks ask me, well, why would I invest in individual stocks when I could just own a fund that has all of them? Great question. Some folks may, feel that certain companies are going to outperform, the percentage that a fund may perform. So they may decide, you know what, I'm going to put my money in these stocks. The thing to know, though, that when you're doing that, it requires you to also actively manage your portfolio. Why? Because you're probably going to be watching the price of it, because stock prices are going to go up and down all day. Essentially, when I teach, I also teach this to high schoolers. When we talk about the stock market, I tell them this: think of the stock market literally as like a market, a grocery store, and or even an auction. And people are throwing out prices that they'll pay for this stock, which is why every day the prices of these stocks will vary, and it'll vary based off of demand. Sometimes if Tesla rolls out that, they're coming out with this new Cybertruck and everyone's super hyped and they think all these things, and yes, all of a sudden everyone is going to want to buy Tesla shares and the price is going to shoot up. But let's say Tesla then announces, oh my goodness, we're not selling as many EVs as we promised we would. Then people start freaking out and thinking, oh my gosh, that means the company is not doing well. Let me then sell my stocks. So a lot of that volatility too is created by investor perception and news that are rolled out. So yes, so the idea when investing and picking individual stocks is that you're looking for growth. People that are saying, I want to pick that one and that one and that one, you're kind of thinking this is going to grow. So just to give you a quick example of how this would look like, I like to use Yahoo Finance, super easy. So even if right now you were to Google Yahoo Finance, And let's say you pick a company, I picked Apple here, and let's say I'm curious and I want to see, I'm interested in purchasing a share of Apple. I really like Apple, and I just want to see what Apple costs. You can Google the ticker symbol for Apple. All stocks will have a little nickname, 3 to 4 letters, and this is how we identify them. And when you look at this is a quote, we would essentially be looking at the stock price. So this was from Friday, or no, this is a little older here. But at the point that I took the snapshot, Apple was trading for $1.47 for that day. I'm not sure at what it's at today, but again, I'm sure it's not at 147 because it fluctuates every day as things go on. But one of the things that I want you to look at, which is really interesting in this graph as we're looking at Apple, look at the growth from 2017 up until now. And again, I want you to pay attention to the volatility because it's not always just straight up. We do have peaks where we come down, then we go up, then we come down. That's kind of, that's the price we pay to invest. And so, but the idea here is long-term, Apple's done pretty well for itself. And considering, you would have bought Apple in 2017, I don't know, something less than $73, but now when I took the snapshot, 147, that's nice growth to see. Now, this isn't a technical analysis class where we're going to be analyzing, what you look for to buy companies, but I'm sharing this just because if any of you are curious or want to continue your learning, this is essentially a snapshot of what you would look like. But there's a lot that goes into purchasing individual stocks. More than this that I can teach in 90 minutes. There's tons of research involved. Now, it's important that you also know that the stock market is literally like a market. So think of it, you go to a Ralph's or a Sprouts or Trader Joe's, and there's different aisles with different things that they're selling, right? We have like the meats, the cookies, the sodas, the veggies, same thing. The stock market is composed of different sectors. We have our real estate sector, right? We have our consumer staples. We have our industrials, our healthcare. This is how it's all divided out. So can you imagine if you're stock picking, how do you know? It definitely takes a lot of research to figure out which companies are going to do well. So this is where when you're purchasing funds, which I'll go into in a sec, you're able to buy this entire market without having to go in here and really do research on all of these different sectors to see, okay, what company do I really, do I think will grow and perform? Now, bonds are a little different where they're fixed income instruments. And like I mentioned earlier, think of bonds as loans. You're making a loan to the company, you're loaning this money to companies, to municipalities, cities, etc. And the idea with bonds, why we have them in our portfolios, bonds aren't really designed for growth. They don't have the same risk as stocks, right? Because if you're buying stocks, that company can go out. I use the example of Sears. Sears is a company that at some point was thriving, and I don't see, Sears is like out of business. I don't see it anywhere. I don't think there's any Sears left here in LA. And maybe elsewhere, but if you had invested all your money in Sears and Sears goes out, well, there goes all your money. So the idea with bonds is bonds are designed to get a moderate return, moderate risk, and they're there in your portfolio to offset the risk of stocks, right? And so we definitely don't want a portfolio, especially retirement portfolio, that's all stocks. Because we want some hedging. And this is what's called diversification, right? Having a little bit of different things in here. So again, stocks mean ownership. When you have them in your portfolio, you own a little piece of that company. Bonds, you are essentially lending these people money. And you get a little, essentially a little bit of the interest back in return. All right, so now let's talk about funds, which are some of my favorite, although in full disclosure, I do invest personally in individual stocks and funds, but I'm a finance nerd and I love to do research on these things. For the average person that may not want to do a deep dive, the research can get heavy to look at individual companies. But again, you can absolutely do that if it's something that you're interested in. So there's 3 types of funds. Most of our retirement portfolios, we're going to see mutual funds and index funds. Now, mutual funds tend to be like a basket of a whole bunch of either hundreds or thousands of stocks in one container. And they're usually managed by someone. They have a fund manager. They've hired a person that's coming in here that's saying, you know what, we think we need to add these companies because they're going to outperform the entire market, and they decide the composition. That is why they have a higher expense ratio. What is an expense ratio? Well, expense ratio is the fee that you need to pay to own that fund. And a part of that fee goes to the fund manager or, the company that's managing that fund. That's how that works. So we definitely want to be very careful when we're doing mutual funds. And I always tell clients 0.5 is the number, 0.5 or below. When we're looking at funds, especially mutual funds, if you're paying, if it says expense ratio equals higher than 0.5, it's kind of high. And you may be thinking to yourself, 0.5, but that's not even a percentage. Yes, it's not even a percentage, but guess what? When we're talking about your portfolio growing to hundreds of thousands, even millions of dollars, that 0.5 really starts to add up. So don't let that tiny little fraction of a number throw you off so that you think, oh no, it's no big deal. It actually becomes a really big deal. And hopefully all of your portfolios are going to grow massively, that expense ratio will matter. Now, the other 2 that we want to look at are index funds, which essentially just track a large portion of the stock market. And these don't really have a fund manager. They're copying parts of the stock market, which is why they're a lot cheaper to own. They have low expense ratios. And, when you don't have a human being there saying, let's put these stocks into this fund, the fund becomes cheaper. So index funds, we definitely want to look at. And index funds are very similar. They function like index funds and exchange traded funds can be done interchangeably. And I say this because exchange traded funds can be index funds. So, and I'm sorry, I know this part gets really confusing for some folks. Exchange traded funds essentially function like a stock. And what I mean by that is that a stock will go up and down all day long as people are buying and selling, and they're saying, I'll pay that, I'll pay that. Well, ETFs, an exchange traded fund, functions that way. The price will go up and down all day as people are buying and selling it. But essentially, exchange traded funds can be index funds. And so that's all you need to know. And typically ETFs also tend to have lower expense ratios, which we always want to see. 0.5 is that number that you should cap expense ratios at. So I'll pause there. I know we're getting into a little deeper stuff. So feel free to ask any questions if you have any at the moment. And Don, I saw your comment. No worries. I'm just trucking along.
Yeah, you're motoring, which is great. Emma had a question that I think you're gonna get to about how to buy so brokerage accounts, and so I won't address that, but I did want to stress the idea of time being more important than amount, right? You showed that example of 30 years. Many of you on this call, in 30 years, you'll only be 50. Now, to you, that seems pretty old, but to me, not so old, and you'll still have another 15, 20 years of investing after that. So this idea of the younger you start, the better off you are is so true. And then being consistent with it, really, really important.
Yes.
That I'll throw it back to you, Cindy.
No, thank you for sharing that. And it's interesting because sometimes when I talk to folks about, investing, one of the things that or even putting money in their retirement account, they'll say, well, what if I'm not alive for then? Like, I've been, putting all this money into these investments accounts and I'm not even alive. And my response is, well, but what if you are alive? And most of us will be, as the age that most of us, it keeps increasing with technology. We are living longer and longer and longer. And I can assure you that within the next 30 years, technology is even going to get better, where we're going to continue just to live longer and longer and longer. And so one of the things that I share with folks is, I definitely don't want you, and this is a mindset thing. If a part of you is feeling like, well, I don't want to prioritize, beginning investing because I have other things, totally understand other things are also important, but carving that little bit now that you're on the younger side, for those of you that are in your 20s, even early 30s, super important, because let's say hypothetically, if you do make it into 50s, 60s, 70s, 80s, well, guess what? You now are taken care of. You don't have to worry about living in poverty. You don't have to worry about how you're going to survive. That's set. And let's say hypothetically, you don't make it. Something happens, and you don't live that long. Well, guess what? This is all money that you have the opportunity to leave to your family to begin building generational wealth. So it's really a win-win. One, you win, you're giving yourself options and, to live the life you want later on. Also, if you don't live that long, it's still a win because other people will have the opportunity to also use that to better their lives. So, I definitely think it's a win-win, and it's never too late to start investing. I actually didn't start my investing journey until my early 30s, just because I didn't know. No one talked to me about this. Like I mentioned earlier, I was taught to save and not invest. So for the longest time, I was just saving, with the money in my savings account, losing its value with inflation, but I didn't know better. But there's still many ways where you can catch up and you can prioritize that. And like Dawn said, I mean, you have time. You definitely have time. So this is another little visual of individual stocks, and let's say an index fund like the S&P 500, which many of you may have heard of. The S&P 500 represents a part of the stock market, and it represents the top 500 companies really in the United States. So we have the big heavy players here. Now, for folks that if you decided you want to start investing and you want to start picking these stocks, and let's say, okay, cool, I want to pick Target, Starbucks, Microsoft, Apple, and these are the ones that I'm going to pick and I'm going to buy. That's great. By all means, go for it. But you can also buy an index fund, buy a fund like the one that tracks the S&P 500, where you can also have Target, Starbucks, Apple, Microsoft in there. And not only will you have these companies in there, but you'll have 500 other companies in there as well. And so this is one thing that, hopefully will take the pressure off of feeling like I have to pick individual stocks and make things a little harder, because you really don't have to. You can, decide to invest in a fund that tracks, the S&P 500, or even the entire domestic stock market, which has over 3,400 companies, and buy this entire fund and not have to worry about picking individual stocks. And really, Warren Buffett, who's one of our greatest investors of all time, he recommends, the average investor, put your money in the S&P 500, the total stock market, and you're kind of set. You really can't go wrong with, investing in an index fund that has so many companies in it. And so this is what we're talking about. One element of diversification, right? You don't have to pick individual stocks. You can just buy a fund that has either hundreds or even thousands of companies, which is really, really nice. And a lot of our retirement portfolios, the foundation will be index funds like these. Our retirement portfolios, when you're contributing through your employer, they usually don't have individual stocks unless you're creating some kind of stock plan with them and they allow you to buy individual shares. But most retirement plans, they're going to have your money in a fund like this that's going to be composed of hundreds or thousands of companies. So these are some popular index funds that you can Google and search. I was going to put the ticker symbols in here, but I don't know if that would come off as stock recommendations. So I figured I will let you Google them. But essentially, one of the ones that I was talking about is you can invest in the total stock market index fund, which means it has every publicly traded company in the US, which is over 3,400 companies. You're buying the entire market. So when people tell me, oh my gosh, Cynthia, but I'm going to lose all my money because what if the stock market crashes? Yes, I understand that's a concern, but the reality is, if all 3,400 company, if every single publicly traded company in the US crashes, your portfolio, I mean, you're with everybody. Our entire economy is down if every, single company is down. The same, with the S&P 500. If our, top 500 companies come down to zero, I mean, we're in big trouble here. So these are some really nice ways to begin investing that provides you diversification, that is a little bit more low maintenance because you don't have to pick individual stocks. You can buy funds that track, the largest components of our, domestic stock market. And the expense ratios for these funds are also very reasonable. So these are, I recommend if you haven't started, and I'm going to talk about brokerages and all of that in a sec, but these are some elements that I want you to think about. So sorry, I'm going to go back to the chat and just going to go up. I have a stock account and have owned some stocks in my country. May I buy stocks in America? Yeah, absolutely. And Jean, I will talk about how to do that in a sec. That will definitely be a portion of this that I'm going to get to. And how much money do you need to start? That's a great question. So it used to be historically, it used to be really expensive to buy a fund, right? And it depends. If you're talking, Emma, if you're talking about individual stocks will cost different prices. And that depends, on a lot of things, but I recommend, Yahoo Finance. You can Google the name of the company and it'll give you a stock quote for individual companies. But let's say if you're interested in purchasing a fund, different funds will also have different prices. Now, there's brokerages, and a brokerage is a place where you go to buy and sell. It's done online. Some brokerages are Fidelity, Vanguard, Charles Schwab, Robinhood. I'm not the biggest fan of Robinhood, but they're also a brokerage. And this is where you come, you connect your account and you fund money in there and then you buy. And so typically the price will vary on the day, on what's happening in the economy, and let's say, for example, hypothetically, you wanted to invest in the total stock market index fund. You want to buy this basket that has all 3,400 companies. How much is this one fund going to cost you? Well, it depends also on who you buy it from, because different brokerages have, their own fund. It's the same version of it, but essentially, if you're buying it from Vanguard, the price may look a little different than if you're buying it from Fidelity or if you're buying it from another brokerage. Now, there's no right or wrong in who you go with. It's just your preference of who you decide to open that brokerage with, but those prices will also fluctuate as well. And if I have time before the presentation ends, I'll show you a stock quote for like a fund for the S&P 500 or the total stock market so that you can get an idea of just what that looks like. Okay, cool. Yes. Oh, well, never mind. I have a quote here for, and this is from February 10th for Vanguard, the S&P 500. So this is an example of a fund that tracks all 500 companies. And as we can see, if you wanted to buy this one fund with all 500 plus companies, a little piece of all 500, the price that it's going for right now is $375. And you're probably thinking, oh my gosh, I don't have $375. I can't afford that. There's no way I can get started. What do you mean start with whatever you can afford? Well, there are some brokerages like Fidelity. Fidelity, I'm not sponsored by any, I don't sell any products. These are just things that I use and I've researched. I like Fidelity and Charles Schwab as well. The reason why I like those two brokerages is because they allow you to purchase something called a fractional share. And a fractional share means, okay, Emma, I want to buy this fund, but I don't have $375. I only have $50 right now. That's what I can spare. Well, guess what? Fidelity and Charles Schwab will allow you to buy a little piece of this fund for $50. And so whenever you can, put another 50, put another 50, put another 50, eventually you'll get to 375 where you will own the entire fund. And so that's the beauty of those two brokerages. Those are the two that I know of that do fractional shares. There may be others, but I don't know about them. That's why I like those two, because you can start with a little bit if you were interested in buying a little portion of either a fund or an entire stock. So those would be the two that I like. Meech is asking, are index funds safer in terms of drops? Like, let's say only two companies. Yes, out of all 500 plus have a significant drop, the investment will still be all right. Yeah, so that's a great question. So the nice thing about these funds is that they themselves are monitoring, right? Every year, every so often, the companies that are not performing, like let's say to be in the S&P 500, out you go and in we bring in. So Tesla is one of the companies that they just got added to the S&P 500 to that list maybe 3 years ago. Why? Because they weren't, this multi-billion-dollar company like they are now. So the nice thing too with these funds is that if the companies aren't performing, they give them the boot and they bring in a company that is performing. Now to your question, if two companies out of 500 drop in that fund, it's not going to have a significant impact. Why? Because we already have 498 other companies that are still kind of holding the fund up. So that's the nice thing about the diversification within a fund, that we don't have to stress about what one or two companies, what they do or how they're performing, because we have so many other companies within that are holding it up. That's actually a really great question. So the drops, to answer your question, will not be as significant as if you only owned individual stocks. With those, yes, the drops can be very severe. And I can tell you that because I know from personal experience. That's a great question. Why not Robinhood? So I'm not the biggest fan of Robinhood because historically they haven't had the best education platform. And for a while there, they didn't let you invest in index funds. And I think, index funds are really a great place for starter, just for everyone actually. And I do believe that brokerages should have some kind of robust learning platform so that people can go in there and watch their videos and have articles to share. I think that's really, really important to have accessible in a brokerage. I just don't like the idea of investing as it being gamified. It's not a game. It's your hard-earned money that you're putting in here. And so this idea of constantly pinging you or, the gamification of it, the idea really with investing, it really should be boring. It shouldn't be something that you're like every day, like, oh my goodness, I'm going to buy now, I'm going to sell. Like that stuff is more, we're teetering on like we're gambling our money here. True investing really is we're putting money into these either companies, individual stocks we believe in, we know they're going to grow, or these funds. We have a nice portfolio. We have a thesis for why we're buying this, and we just let it grow. Very, very little management of buying, selling, buy and selling. And so those are just my personal reasons for, not being a huge fan of Robinhood. But if you are, amazing, use what works for you. Titan, I have not heard too much of Titan. I may have to do some research on it now because I had not really learned about Titan. So you want to invest, right? Where should you start investing? So I'm going to skip the poll because I want to be mindful of time, and I want to make sure I get to the good stuff. So a couple of things to keep in mind. Super important that before you begin investing, you have your emergency fund set. You want to make sure you have enough to cover you in case there's an emergency. You also, Don mentioned this earlier, consistency is what builds your wealth, right? The idea is if you can carve out $20 to automate every month into this, that is consistency we want to see. So I always, when I work with students or clients, I say, let's look at your budget. How much can we realistically allocate to these accounts every month so that it's automated, it's carved in, and, set it and forget it. And then 2, what are your goals for this money? Like, what is this money going to be for? Is it just for retirement? Is it for a vacation? Is it for, when do you plan to touch the money? And if you have debt, important that you run those numbers to see if investing makes sense, right? I do think it's possible to begin investing when you have debt, but we have to run some numbers to see if it makes sense. It really depends on your goals, and different investment accounts are going to be used for different goals. So let's take a look at that. So these are typically the 3 types of accounts that we're going to see, and hopefully you will all have in your lifetime because they all serve different purposes. An employer-sponsored account, that's going to be composed of stocks, bonds, index funds, mutual funds, target date funds, cash. This, of course, it's got a little lock here. Why does it have a little lock? Because anything that you're typically contributing to your employer-sponsored account as a 401k, Roth 401k, that money is locked in there just for retirement. So we got a little lock on there. We can't touch it till after 59 and a half. We do that through our job. Now, at the beginning of the presentation, we saw that a lot of y'all hadn't started yet. Employer-sponsored is a great place to start. But another place, if you do work, you have some form of employment, and let's say your employer doesn't offer an account or you just want to start one on your own, is a Roth IRA. Now, I love a Roth IRA. You're going to see the little lock is not fully closed. And I'm going to talk about that in a sec. And then the last account is a taxable brokerage account, no lock, which means you can access this money whenever you want. So important that you pay attention to this. Employer-sponsored, locked, Roth IRA, half lock, taxable brokerage, no lock at all. So employer-sponsored account, why do we want to start here? Well, you have a potential for a match. They may match what you contribute. There's tax advantages depending on the type that you select. And we want to take advantage of those taxes. And again, you have access to these funds until 59 and a half. Now, these are the 2 types of accounts that you'll typically see with your employer-sponsored account. One is a pre-tax and one's an after-tax. The pre-tax is in the traditional IRA family. It looks like a 401k, maybe a 403b, 457. And the nice thing about this is that it reduces your taxable income. But guess what? That means when you're 59 and a half, you have to pay taxes. So we want to think about that. The other account that your employer may offer is a Roth 401k. And the nice thing about this one is you're paying taxes on it now. But guess what? You reach 59 and a half, no taxes. You're absolutely done. If you've reached $1 million, that whole $1 million is yours. So those were the 2 main ones at work. Now the investment accounts outside of work. So this is where we have the Roth IRA. Now, I am a big fan of the Roth IRA. You open this one on your own through a brokerage like Fidelity, Charles Schwab, Vanguard, all of these brokerages. And the nice thing similar to a Roth 401k, is that it's post-tax. You have already paid taxes on it. You know, when we pay our income tax, you pay taxes. So any growth in this account, tax-free. Now, because this account is so powerful, when you have this tax-free growth, the government, the IRS is saying, guess what? We can only contribute $6,500 into that account per year. That's it. Once you hit the $6,500 for the year, you got to wait till next year. And the catch to this too is that you can't make over the adjusted gross income for that year. So for 2023, if you're making over 153K, you can't contribute into this account. So the reason why I love this account for younger folks that, you know, are not in the high earner category yet is take advantage of it. Because really at some point in life, as your salary increases, you may not be able to take advantage of this account. So while you can, you know, when you're younger, you tend to make less in your career. While you can, this is a great account to take advantage of. Now, here's also the reason why this account doesn't have a full lock on here and it has a half lock, because a Roth IRA, any money you're putting in here, you can actually take it out at any time. It's not locked in here. But guess what? Let's say you put $1,000 in here and you decide in 2 years, oh my goodness, I have something happening and I need my $1,000. But this account has now grown. You've had it in the stock market. It's now doubled. It's now $2,000. Well, the IRS is letting you take out that initial $1,000 that you put in here. But guess what? The $1,000 that you had in growth, that has to stay in here. So this is why it has a half lock. Your contributions, you can access at any point, no penalties, no taxes, none of that. You pull your money out, but any growth has to stay in here, which is really nice. Another thing too, which is fantastic about this account, is that if you've had this account for at least 5 years, the IRS will let you use up to 10K of contributions and growth for your first home. There's actually an entire list of exceptions that the IRS will let you use money for, which is really, really great. So for those of y'all that, you know, are not homeowners yet, but you're thinking, you know, at some point I may want to become a homeowner and I want to start saving for that. But I don't want to put it in a savings yet. It's later down long term. A Roth IRA is a great option as well, because the IRS will let you take out that money for that. So this is why, you know, the Roth IRA is a nice option. Now, the last account that you can invest outside of work is a taxable brokerage account. Now, the taxable brokerage account, no lock on it, as you can see, none at all. There's no stipulations about time. You open this on your own, same, any of those brokerages, and you can withdraw your money at any time. You put money in there today, you can take it out tomorrow. There's no lock of any sort. Now, one of the reasons why typically this is the last account that we fund is because there's no quote unquote tax advantages. You know, with your 401k, IRA, you know, it's reducing your taxable income when you work. With the Roth, you're paying taxes now, but you won't pay taxes after 59.5. With this one, there's no setup like that. So essentially what happens is whatever you decide to buy in here, whatever funds, stocks you buy in this account, when you decide to sell, you're just going to be paying a capital gains tax. And the capital gains tax, the tax you pay on the growth, has to do with how long you've held the assets. So it's very possible that depending on where you fall in the tax bracket, you may pay 0 taxes, maybe 15 or 20%. It all depends on how long you've held it, if it's been over a year, and then where you fall in the tax bracket. So that's also a nice option. So before we buy, now that we know, now you've got to decide, well, what account am I going to buy, right? You may have an idea now. I want to buy individual stocks, or I want to buy index funds. We may have an idea of that, or both. And now we talked about the accounts. Do I want to contribute to my employer? Do I want to open up a Roth? Or maybe I just want to start with a taxable brokerage account. Now the big question is, do you want to manage it, or who's going to manage it? Like, do you want to go in there and pick what you're going to buy, or do you want someone to do that for you? Now, this is where we have typically three options. You can do it yourself. You can decide, you know what? I want to manage this. I want to go in there and buy stuff. I want to select the index funds or the stocks that I want to buy. No fees to manage. You're in there, you're doing the research, you're buying stuff. You can also decide, you know what? I'm going to give robo-advising a try. And robo-advising, essentially what this is each brokerage has an algorithm, all of them have it, where you can think of it as like AI is creating a portfolio for you based off of the survey that they give you. So they're going to give you a whole bunch of questions. And from there, how you answer them, depending on, you know, your risk tolerance, if you're fearful, if you want to be more risky, more conservative, when you want to retire, what this money is for, based off of this list of questions, they're going to create a portfolio for you. And, you know, the fee isn't too bad. It's about 0.3. Remember, I talked about 0.5 and less. So it's not too bad to have AI create a portfolio for you and manage it. That's option number 2. Option number 3 is what's called a target date fund. And target date fund is what we typically find in our retirement portfolios, but brokerages will also sell this. And it's essentially one fund comprised of stocks and bonds that really are designed based off of the date that you want to retire. Whether that's 20, 50, 60, they're going to map out, okay, in 20, 30 years, this is how we should allocate all of this stuff. So these are typically your 3 options when it comes to who's going to manage this. So I kind of talked about this a little bit. So let's jump into how to get started. Well, we're going to do our research, right? We're going to look at our budget. We're going to decide how much you can start with. I think that's the best plan. You know, looking to see consistency is really important. How much can you afford? Can you set aside 20 bucks each month, 40, 50, whatever that may be? And then you want to think about it. Do I want to do a little research and you know, pick some stocks that I like, or pick some funds that I like, and kind of start compiling this portfolio myself? And then you also want to pick a brokerage, right? You want to decide, okay, do I want to go with like a Vanguard, a Fidelity, a Charles Schwab, TD Ameritrade? And some of the things that I would say that you want to look for in a brokerage, go to their website, look around, get a feel for it. You want to make sure there's no fees. I think having an education platform is pretty important. And I think for the most part, you want something that allows you to buy fractional shares, especially if you're starting out and you will only have a little bit to contribute. You want something that allows you to buy a piece of it, not having the whole $300-400 for whatever it is that you're buying. And then, you know, once you pick a brokerage and you open your account with them, you're going to fund it. You're going to connect it to your checking account. And you're going to hopefully automate it so that every month you're transferring a little, although you don't have to do that. You can do a one-time thing. And then once you fund it, you have to purchase things. So a big mistake that I see with a lot of the clients that I work with is they'll open this. They'll say, Cynthia, I opened my Roth and it's been open for years and I'm investing and I'm so excited. And I'll say, that's amazing. What did you buy? And they'll say, well, what do you mean? I bought the Roth IRA. And I'm like, no, but what did you buy? And they'll say the Roth IRA. And I'm like, no, the Roth IRA is the account. It's the container. Now we got to go in there and buy stuff. So important that you do that. And then hopefully you're going to automate stuff. So, oh no, the picture didn't come out. What happened? Oh, okay. Sorry about this, y'all. I actually had created a graphic, probably one of the most important slides that showed here how you go about doing it. But something happened here where it's not here. So my apologies with that. So again, once you transfer your money, don't forget to buy the assets. We are going to skip the poll, and I want to leave some time for Q&A right now. But before I do that, here are some really great websites to get you started with your research. I highly recommend, if you haven't yet, and you really are interested in investing, sign up to start receiving newsletters from some of these guys. You know, Yahoo Finance is great to do research. And as you saw, to go in there and get a quote for a ticker symbol. I like Atom Finances, Seeking Alpha, TradingView, ETF.com, Investopedia, Morningstar. These are all great if you're just trying to learn a little bit more and just want some articles. So with that, let me get to the questions because I want to make sure I answer all the questions, and then I'll get to the mentee questions too, because I'm not sure if any came in there. So is the Roth a good option if you'd like to be an early homeowner as well, or is it just good for long term? Well, like I mentioned, the Roth is a very flexible account. It's a retirement account. It's a Roth IRA. Anything that has an IRA, it's a retirement account. But it has those exceptions that are really nice if you do want to be a homeowner. So, if I can have this Roth IRA and I can have it open for at least 5 years. I'm not planning on buying a home for at least 5 years. I can do that. Then, just knowing after 5 years, if you needed to, you could take out 10K. But here's a thing that I want you to think about, when we're putting money in there. If you do decide to put money in there with this idea that it's for home ownership, you also have to understand that the market is very volatile. It's very possible that at the time you want to buy a home, we're in a bear market and the market is down. And guess what? At that point, you don't want to take out that money because it may be potentially at a loss. So you kind of have to wait until the market goes back up till you can take that money out for a home. So this is why, I recommend, just funding money into a Roth IRA because, you have flexibility, but knowing, if after 5 years, I do want to use 10K to buy a home, it also has to be a good time in the market where, I'm potentially taking this money out and it's not at a loss. So that's kind of how I would look at that. What savings accounts do I recommend? I love this question because I also love savings accounts. Right now, high yield savings accounts is where your money should be. So I definitely recommend Ally is a good one. The APY is at 3.4. Capital One Performance Savings also, I think, at a 3.4. SoFi, I think the APY is at 3.75 right now. Marcus, Discover, all of those are probably my favorites for high yield savings accounts. Why are they my favorites? There's absolutely no fees. We want to do no fees. There's no minimum to have in those high interest accounts. They're FDIC insured, and all savings accounts across the board allow you 6 withdrawals per month. So all of them have that. Is investing through banking apps good, or is it better just use a brokerage? That's a great question. I don't have too much experience with banking apps, but I would say, and this is just as an assumption, they're probably not as robust as a traditional brokerage in terms of offerings. They probably don't have all the index funds or, even all those stocks. So I would say do some research to see if they provide the offerings that you're looking for. Isn't that a self-directed IRA? Sorry, I'm not sure. I would need some context for that. Is Roth IRA the suggestion if you're an independent contractor, since there's not an employer sponsored? Oh, yes. Okay. Yeah. There is a self-directed IRA. There's a solo IRA that you can contribute to. Oh my gosh, there's another one at the tip of my tongue, but there's I believe 2 or 3 different IRAs that you can contribute to if you are an independent contractor. If you're self-employed, you have your own business. If you just do a quick Google of, best IRAs for, independent contractors or small business owners, and I apologize, I should have included that in here. That is me. That is on me. Yes, that will give you the 2 to, I believe it's 3 different accounts, but yes, self-directed IRA is one of them. And how many times do we invest? 375 every year or every month? How many times? Sorry, I'm not too clear, Emma. If you want to clarify on that question, I'm happy to answer it. Okay, cool. And I guess I'll go to Menti now and see if there's any questions here. Questions, here we go. Okay, cool. Let's see. I don't see, nope. And so it's best not to invest until we have money we're comfortable losing. Yes, that's a great way to put it. Whoever asked this question. Yes, I highly recommend that, you invest money after you have your emergency fund set. Having an emergency fund is so important. This is how, as I work with tons of different clients, people get into debt. They don't have a little bit of money saved up. An emergency happens. And what do? We typically go to a credit card, right? If we don't have that money. An emergency fund helps you avoid that. So I would say once you have your emergency fund, and then, you're looking at your budget and you're like, I have a little bit of money left. I think I could start with this. At that point, I think it's a good time to begin, putting aside a little bit into these different accounts. And yeah, if you want to look at it that way, I know when I first started, I was terrified because I didn't really know what I was doing. I was trying to figure it out. And so I remember looking at my savings and thinking, yeah, I'm only going to invest $200. And I looked at it in my mind. If I lose $200, I'll survive. Like, I'll be mad, but it's okay. And that gave me peace of mind knowing if I lost that. But what happened over time, I'm so glad I did it though. And I opened that account even with that amount, because over the years, over time, I started to get really comfortable and really understanding the ups and downs of the markets. And the more comfortable I got with seeing the money there and the account grow, the more that built my confidence. And then that's when we were like, okay, I have confidence now. I know what I'm doing. I feel good about my choices. Let's do this. So yeah, absolutely. I mean, I think that's a great mindset too. If you're scared and you're worried, looking at it, not investing money that you need, investing money that you're comfortable losing, I guess. And when buy stocks,
Yeah, I think that question is related to timing. Should they put a little in every month or once a year?
Oh, gotcha. Yes. Consistency is so important. So if you have the ability to put aside a little bit every month, absolutely do it every month. Why wait a year? Again, time really is in your hands. Like time is what we need in the market. And so if you decide to put off, investing, just you're doing it once a year, you're losing out on time, on growth. So absolutely, even if it's a little bit, like I said, a lot of the times, it may be difficult because we may have a really tight budget and we have conflicting needs. Totally get that. But if you're even able to carve out, like I said, even $20 and start with that, and you start building the habit and you start learning how to navigate the platform and the dashboard, and you start seeing what it does, all of that is really part of the learning experience, which will really help build your confidence in seeing, oh, okay, this is what it does. Okay, cool. This is now starting to feel normal. And so that's why I'm a big fan of even starting with a little bit, getting comfortable with what you're doing. And then, as you're able to afford more, increasing, your contributions.
One more comment I'll share as well, Cynthia, is keep in mind the vehicle you're using. If you're investing in an IRA, Roth or otherwise, retirement investing, there are penalties if you pull it out early. So money you may need for a home, you wouldn't invest in retirement. You'd invest that maybe in a cash brokerage account. And then lastly, really important, the shorter the time and the fewer the stocks, the higher the risk. If you're buying Apple and you're holding it for a week, you're gambling essentially, or you're day trading, very high risk. If you're buying the S&P 500 index every month for 30 years, much lower risk. And based on the chart Cynthia showed at the beginning, there over 30 years, there has been little to no risk. The market goes up over time. Anyway, with that, we are at the end. Cynthia, so glad we had you back. Just fantastic information. And folks, we have 4 more of these workshops. I'm going to drop the flyer in every other Tuesday at 3. The link you used to get here will work for any of those. So now that you're here, you don't need to register over again. Hopefully we will see you on some other workshops. But again, Cynthia, just thank you so much for that great info. We have recorded this. You'll get a link to the recording for those of you who may be asking. And with that, I hope you all have a fantastic Valentine's Day. Bye, everyone.
Bye, everyone. Thank you.